A banking crisis has been roiling global financial markets. We've seen the collapse of Silicon Valley Bank and Signature Bank. Many other banks have come under financial pressure. First Republic Bank has been downgraded twice by credit rating agencies. Furthermore, Credit Suisse was recently acquired for the rock bottom price of $3.2 billion, which at least was not quite as bad as the prior offer of $1 billion. And some of the security holders in Credit Suisse have now been wiped out reportedly. However, this all begs the question of whether Australian banks are safe. Is your money safe in an Aussie bank account? And it turns out there are actually some good reasons to be at least reasonably reassured by the Australian banking system. The first reason we can be relatively confident about Aussie banks is interest rate exposure. One of the issues with Silicon Valley Bank is it took a lot of deposits in when money was very cheap. This money was often coming from tech and startup firms and VC-backed firms. It took this money in and then it needed to lend it out. But because Silicon Valley Bank didn't have many good investment opportunities, it would often lend this out by buying government bonds or mortgage-backed securities. This would involve effectively lending money to the government or the issuer of that mortgage-backed security. Now the problem here is that those were paying out incredibly low interest rates, and those interest rates were fixed throughout the life of the loan. Then lo and behold, the Federal Reserve starts hiking rates. Now this creates a couple of problems for Silicon Valley Bank. First, those old loans are paying out very low interest rates. However, Silicon Valley Bank was needing to pay higher rates to get money back into the bank, so there was a cash flow problem. Second, those assets started to decrease in value. The way to think about this is, say you've got a bond that's only paying out 2%, but now the prevailing market rate is 4%. Well, that old bond is going to go down in value. And Silicon Valley Bank faced this across its portfolio of both available for sale securities and held to maturity securities, which created a bit of a hole in its balance sheet and exacerbated the whole underlying problems with Silicon Valley Bank. By contrast, Aussie banks are often lending out a lot of money as mortgages, and these mortgages have variable interest rates, which means that a lot of the problems that Silicon Valley Bank was facing simply aren't relevant to Australian banks. The second and related reason pertains to managing interest rate risk. Now, as I indicated, when interest rates were going up, this created a major problem for Silicon Valley Bank's balance sheet. Now, the way an ordinary, competent bank would deal with this is they would actually insure against that interest rate risk. Silicon Valley Bank did not. Now, with a normal bank, what they would do is they'd hedge that risk. This might involve undertaking swaps or something along those lines. Now, the technical details are really beside the point for the moment, but a normal bank would actually take steps to mitigate that interest rate risk. This would typically be the case for most American banks, particularly larger American banks. For Australian banks, they in fact have to do this, and there is a vested interest in doing so. This is because APRA, the Australian Prudential Regulator Authority, will impose a capital charge for that interest rate risk, forcing banks to keep more money aside as capital in order to offset any problems involved with higher interest rates. Indeed, we've already seen that banks, when they were caught unaware by the rapid rate hikes that we've seen over the past 12 months or so, banks had to put more money aside as capital. We've already seen this come into play, which hopes to ensure that the Australian banks are significantly more stable than some of those regional banks that are having problems in the United States, such as Silicon Valley Bank or Signature Bank, or some of the other ones that are coming under pressure. The next issue pertains to the deposit side of the equation. That is where banks are getting their money from. Now, in Australia, banks need to maintain liquidity coverage ratios, which basically means they need to have enough money aside in order to meet vast deposit outflows. Now, in Australia, this appears to be relatively less likely than it was with, say, Silicon Valley Bank. One of the many problems with Silicon Valley Bank is that it had a very concentrated depositor base. That is, a lot of its depositors were in the tech area or startups or venture capital backed. Now, this created a couple of problems. When one of these companies was suffering financial problems, well, it was quite likely that many other companies would be, and therefore many companies would all need to withdraw their deposits for purely financial and economic reasons. And this creates a problem for Silicon Valley Bank because they need to get more money in, but they need to pay more money to get more deposits in because of interest rates going up. And that created that cash flow problem for Silicon Valley Bank, in addition to deposits simply being less forthcoming. Not only this, when a bank run occurs with Silicon Valley Bank, well, a lot of those depositors were highly interconnected. After all, if a startup is spooked, well, that might also spook the VC fund that is invested in them. Or if a VC fund is spooked, well, that will spook all of the startups and the other VC funds that it is doing business with. And therefore, you can get this contagion effect throughout the deposit side of the equation, triggering a bank run. By contrast, in Australia, the banks are much more diversified in their deposit base, and therefore they're much less exposed to that type of contagion type scenario, i.e. they're less exposed to just one sector of the economy, and they're less exposed to that network effect. Furthermore, the banks in Australia need to ensure they have adequate liquidity coverage ratios in order to stave off any risk of a bank run of that nature. And indeed, even if we're looking at companies like Credit Suisse, which have suffered significantly recently, it even was able to meet its deposit outflows. So the problems with meeting deposit outflows were very present with Silicon Valley Bank, but they weren't even present with Credit Suisse. And the Aussie banks are in a substantially better position than either of those entities were. The next reason is profitability. Australian banks make rather large profits. We've seen them do this year after year after year. Now, many people decry this. They see this as the bank's profiteering, failing to pass on rate hikes to depositors, or perhaps charging too much to mortgage holders. However, there is a bright side of this, and the bright side that these banks appear to have less operational risk and less profitability risk than, say, a bank like Credit Suisse. One of the underlying problems with Credit Suisse was profitability and how it operated. That is, while it was still able to meet its deposit outflows, it simply wasn't very profitable. It was lurching from crisis to crisis to crisis. For example, there was a leak of its clients, and then after this, we had a Kegos, which cost it about $4 billion. Then we had its involvement with Greensill, and then we've had the various criminal investigations into what Credit Suisse is doing. Ultimately, in its latest financial report, it revealed its largest loss since the global financial crisis. And not only this, some concerns were raised about the veracity of Credit Suisse's reporting. All of these problems created a genuine business risk within Credit Suisse and a lack of profitability. This contrasts with the Australian banks, which are significantly more profitable and therefore would be significantly more able to weather a storm than, say, Credit Suisse was. And therefore they are much less likely to face the same risks that Credit Suisse ultimately faced. And therefore they appear to be much safer than either Credit Suisse or perhaps Silicon Valley Bank or many of the other banks that appear to be on much more shaky fundamentals in certain parts of the United States. The next issue is regulation. In the United States, there's a rather bifurcated approach to regulation, with some banks, particularly the smaller banks, being subject to significantly less stringent regulation than the larger banks. By contrast, in Australia, all banks are subject to the same regulatory regime. And this means those smaller regional banks are still going to be much safer than, say, Silicon Valley Bank ever was, because they're subject to significantly more stringent regulation. And this means Australia is less likely to be brought down by a weak link in the chain of the banking system. The next question, of course, is, are Australian banks going to be affected by this banking crisis, or are they going to get away unscathed? Now, on the one hand, Australian banks are in a good position. They are unlikely to be fatally or catastrophically wounded by this banking crisis. They are unlikely to go under. However, on the other hand, it still is going to affect them. When banks are failing all over the place, Signature Bank, Silicon Valley Bank, for example, and other banks are in a precarious position, will it increase the cost of capital for various banks. This is especially the case since Credit Suisse's hybrid holders were reportedly wiped out. And this means that many people are going to demand a high rate of return for them to be willing to invest in many banks, particularly the slightly more precarious banks, but that then will ultimately feed through into the stronger banks. And then ultimately the cost of capital for these banks could increase slightly. Now, banks, of course, might pass this on to customers. They might pass this on to someone who is looking to borrow to buy a house or has an existing mortgage. Or maybe they might pay less on deposit rates. Regardless, these banks are likely to pass on this cost to customers. It's unlikely to fatally wound the banks, but certainly it isn't great. It isn't great for their cost of capital, nor will it necessarily be great for their cash flows, because they might not be able to pass on the full extent of this cost to all of the customers. So overall, the banking crisis is unlikely to bring down these banks, but certainly it does impose some costs. The question is then, what should you do about this banking crisis? Well, if you've got savings in an Australian bank, if it's under $250,000, well, that's insured via the Australian Prudential Regulator Authority. However, if your savings are above $250,000, well, it would be prudent to spread that across the banks, especially the bigger banks, if you're lucky enough to have savings of that level. Spread it across the big four banks, because that way you might not hit that $250,000 threshold, and therefore the insurance would pay out when it is spread across as such. And that would be the prudent thing to do. If you're looking at investing in general, I'm not going to give you investment advice about investing in any of these banks, but bear in mind there is going to be quite a bit of risk. We're still seeing some volatility in the United States with myriad regional banks. So if you were to buy or sell any of these banking shares, just bear in mind there is a lot of volatility, and at least in the short to medium term, you are going to face quite a lot of risk when investing in those companies. So be rather careful about doing so. Do so with full information. Make sure you're basing it on the latest information about those banks and about the banking system, and you're not just gambling your money away, because gambling your money away is probably not ideal. And in the case, that's what's happening in the Australian banking system, whether the Australian banks are going to be brought down by this banking crisis, and whether the banks are going to be reasonably resilient. If you've got any thoughts about what is going on with this banking crisis, or about the Australian banks, let me know that in the comments below. Otherwise, thanks so much for tuning in, and hopefully I see you next time as well.